If you're guessing where rates are going instead of understanding what's driving them, this week gave us a perfect example of how fast the narrative around rate direction can flip. Hey, Becky here, independent mortgage broker since 2004. I've seen the ups, the downs, and everything in between. Let's break down what's happening right now and what it actually means for your mortgage decisions. Okay, let's start with the big one. Oil absolutely tanked, down over 7% in a single day, on talk that the US and Iran might be moving toward a peace deal. How does this affect your interest rates? Because oil equals inflation pressure and inflation equals interest rates. So when oil drops, it takes some pressure off fixed mortgage rates, at least short term. But, and this is important, this whole situation is fragile. If that deal falls apart, oil can spike just as fast. So this isn't problem solved, it's more like temporary relief. Now, at the same time, Canada's economy showed some sign of life. The IVPMI jumped to 57.7. Are you asking me, Becky, what the freak is the IVPMI? It's a monthly indicator that measures change in Canadian economic activity, and reading above 50 indicates economic expansion. So, translation in normal terms, businesses are still active, hiring is happening, and prices are still rising. So, no, we're not in a dead economy. We're in this weird middle zone of not booming, not crashing, just stubbornly hanging on. Then we've got Bank of Canada Governor Tiff Macklem speaking again, and he's using the word changes. Now, central banks don't accidentally use words. If he's saying changes, that means they fully expect to move rates. The only question is how much and in which direction. Just before we hit that fork in the road, don't forget to hit that like and subscribe button if you're enjoying this content. Here's the reality right now. We've got two completely different paths in front of us. Path number one is inflation stays sticky. Oil rebounds, economy holds up. The result is rate hikes. Path two is growth weakens, trade issues hit Canada harder, and the result is rate cuts. And Macklem basically confirmed both are possible, which is why the market is so confused. Right now, investors are betting on about 1 to 2 rate hikes by the end of the year. The first real move is expected around October. So, not aggressive tightening, but also definitely not cuts yet. Okay, let's bring this back to real life. If we get those small changes Macklem is hinting at, here's what the data is showing. A 3-year fixed mortgage is coming out ahead. It beats variable and even beats the 5-year fixed on interest cost. Why? Because it rides that middle ground. You're not locking in for too long, you're not exposed to short term volatility. But this is where it flips. If the economy flips and those changes turn into rate cuts instead of rate hikes, the variable would win. So this is not about picking the best rate. It's about picking the strategy that fits your risk tolerance. Here's the honest takeaway. We are not in a clear trend right now. We're in a reaction market. Oil moves, rates react. Headlines change, expectations flip. One data point does not set direction, which means trying to time rates is still one of the riskiest strategies out there. If you're trying to decide between fixed and variable right now, or wondering whether a 3-year term makes sense for you, that's a strategy conversation, not a rate conversation.